All right, well, hello everybody and welcome to this week's client support webinar. My name is Bennett McDowell with traderscoach.com. And I've got Gene here, my sidekick. And Gene, let me just ask you, is there anything you want to throw in today? Any announcements?
I love being your sidekick. Let's see. Well, welcome everybody. I do want to throw that in. And lots of folks that were just with us, in the last webinar. So it's great to see you all here. And I guess first thing I'd love everybody to do is just type a hello to me in the questions area. That does let me know that you can hear our voices and see the webinar screen. And other than that, Ben, I think back to you.
Boy, that's got to be one of your quickest ones. My goodness. Okay.
Short and sweet.
All right. Very, very good. All right. So, Jeannie, just go ahead and mute out then, and then I'll go ahead and get started. So welcome, everybody. All right. Let me just go through a few administrational items here. First thing we have to talk about is the risks involved in trading, and there are risks, but that's where the opportunity is, right? No risk, no opportunity, right? So the two go hand in hand, but you need to be aware of the risk, and you need to know how to protect yourself against the risk. And we do that through, trade size, risk to reward, and things of that nature. Also, too, there's two types of risk. What kind of risk? What are the two major types of risk? Anybody out there? What are the two major types of risk? Let me hear what everybody has to say about that.
I'm wanting to jump in.
No, you're not allowed to.
Jim Blue definitely knows the answer to this.
Well, I'm going to just give it a little time. I got some answers coming in.
I know.
All right, trade risk is one. That's correct. And we'll talk about that in a minute. What's the other one? What's the other one that's very, very tough to guard against? Right, market risk. That's it. Good job, John. Okay, so market risk. All right. So market risk is it. And market risk is basically, let's just talk about the two types of risk for a minute. Market risk is something that you have that comes out of nowhere, okay? Like a black swan event, correct? And it could be caused by a variety of different factors, maybe, war, terrorist attack, something unseen, and it causes the market to gap. And the problem with that is it can gap right past your stop. And so therefore, by the time you actually get out, because it gapped past your stop, you get out at a much larger loss than you thought. And there's really no way to guard yourself against that, except always trade with risk capital. This is why no matter how much money you have, okay, you don't always trade with all of it. Okay, really important. So you got to decide what money you can afford to risk just in case that black swan event occurs, because they do from time to time, not often, but it only takes once. So you got to be careful about that. Now, trade risk is something we've talked about, and that's all about the risk to reward calculator, trade size calculator. That's where we calculate our trade size. So no matter how far away our stop is from our entry, if we calculate the trade size correctly, our risk should be basically the percentage amount we want to risk based on that calculation. So that's something we can control, whereas market risk we really can't, except for the actual amount of money you afford to risk, which is basically your account size. All right, so that's kind of an important thing to think about. All right, also too with trading, we deal in a realm of probabilities. Nothing's guaranteed. Nothing is guaranteed. We usually try to trade with an edge, but that edge does not always work, and therefore that edge represents a probability of our success rate. So if you're successful 60% of the time and you can keep your losses in line, you'll do well. All right, if you don't, you could still end up losing. So risk control becomes very, very important. So it's worth talking about that, because I think especially, I have a lot of new people here, And if you don't have good risk control, all right, you're going to set yourself up for problems down the way. And finally, too, actual performance is not necessarily what we think it's going to be based on hypothetical or simulated performance. And that has to do with, fills could be a little different, actual fills and so forth. And then finally, check with whoever manages your money, like your financial advisor, to be sure that anything we talk about, including trades we may look at, are suitable for you. There's a lot of factors that will go into effect, that are taken into effect rather, that may make certain trades suitable and certain trades not suitable for you. And they're going to know that because they know your personal situation. All right, so that's important stuff. All right, moving right along here. All right, I have a bunch of books available. Usually most people these days buy them on Amazon. Back in the early 2000s, most people bought them at Barnes & Noble. So things have changed a little bit that way. And you can still get them at Barnes & Noble or the major bookstores, but most people use Amazon. My new book coming out, it's going to be the second edition of The Art of Trading. It's going to be great. Okay, we're putting a lot of new material in there. So if you got the first edition that came out in 2008, get the second one. There's a lot of new information. People say, well, what's the difference going to be? Well, we're going to put in multiple time frame analysis, how to use it. We're going to put in there drawing fibs properly. We're going to put in there a whole host of things, connecting the dots, for example, what dots to connect and how to do that properly. So you don't actually have so many things you're looking for. You can't have information overload. You can't have too many dots to connect. So there comes a time when a certain number of dots is really all you need and all you should need. All right, so that's what that's going to be in that book. And then, of course, I have money management and Elliott Wave as well. All right, now when we talk about software, one of the reasons I call our system the ultimate trading system is simply because we cover the major bases that software needs to look at when you place a trade. In other words, we have charting software that gives us entries and exits based on price patterns and then confirms it with momentum located in the OWL indicator. And then there's times when the PTF indicator is also helpful to tell us whether a trend is done or not. And then the TLM is great to use when we add into trends because we want to make sure we have an established trend in place. A lot of times when we take our first trade, for example, it's coming off the bottom and we may not basically have that bottom signaled as a trend yet, right? So you got to be aware of that. So let me make sure you guys can still hear me. I've got something funny going on in my webinar software that says it's reinstalling it. I don't know why it's doing that, but I want to make sure that that doesn't cause a problem. I guess that hopefully that did not. That was kind of weird. You guys can still hear me, right? That was the weirdest thing. Okay, all right, I think we're good still. All right, so, okay, good. So that is one thing our charting software does at the top, and the TLM draws automatic trend lines in there. And so we don't want to add into a trend until we have a trend established. That's the initial entry will get in near the bottom. So we don't expect a trend yet. But when we do an add-on, a pyramiding in, we want to make sure the trend is established, and we look at the TLM for that. And then the emotional reader index we use primarily for scaling out or taking partial positions off the table when fear and greed make markets manic and get far away from an orderly trend. So those are the charting software tools. And then we go down to the middle line there, and that's all our scanners. And we have the multiple time frame scanner. We have the trade confirmer scanner, the turbo scanner, and the Elliott Wave scanner. And Jim Blue was here. Hello, Jim. He was using the scanners and found a great stock to actually day trade. So you can use them day trading as well as position trading. And he talked about that earlier in our Yummy session. So good job on using that. All right, and then at the bottom here, we have our risk control software. And this rounds out what I think software tools should do. So you got charting software for entries, exits, and stop loss placement and confirmation. Then you've got the scanners. Those are how you find things to trade. And then the last column at the bottom is how you can control the risk as best we can with our risk control software. And so we've got the risk to reward calculator and the trade size calculator. And the difference between those two is basically risk to reward, obviously. In other words, the risk to reward calculator does everything the trade size calculator does. The only addition it has is you put in your target and it will give you the risk to reward ratio. The trade size calculator doesn't do that. So if you have just the trade size calculator and you want to add that dimension into your trading, which I suggest to do, is upgrade from the trade size to the risk to reward calculator. And it's fairly inexpensive. I think it's a $69 upgrade, but you should do it because it will help you. All right, and then I've got on the far left-hand side of that bottom column, the trader's assistant. And this is how we keep track of our P&L and all the information that we need to see how our trading system is working. And I use that in our day trading room. It will give you your payoff ratio, which is your win percentage and average win, or actually the payoff ratio is your average wins versus your average losses in a ratio. And then it will give you your win to loss percentage. And then it will give you your largest win, your smallest win, number of days you were in the trade, and things like that. And you have trade posting cards for the exact information on the trade where you can upload charts to it. And so therefore, when you go back in time to review your trading, you can actually open up the trade posting card and open up the chart you might have downloaded into the system and take a look and see what the chart looked like. So it's great for analyzing your trade and keeping your trade results right at your fingertips. So that's why we call it the ultimate trading system. It's not just entries and exits. We try to give you just every tool you need in order to have a balanced and robust system. So that's kind of the deal behind that. All right, let's come out of here. And here is TradeStation, and here is Ninja Trader. And any questions on our software? Let me just start out from there. Any questions on our software? Okay, I'm getting a question on how to draw fib retracements and extensions. All right, I think the best way to do that, let me just first give you the theory behind it. All right, so I'm going to bring up a whiteboard. You should see nothing but white right now. So the idea is when a market is trending, all right, let's say we have a flat market here, and it could be an uptrend or downtrend, but we'll say it's an uptrend, and the market breaks out, right? Usually after the first breakout, it pulls back. Now, this is why you always want to put your stop at the very bottom of the breakout, even if you get a pyramid in here. Don't use the pyramid, use the bottom. And breakouts are different than like a wave 3, because the first breakout is a wave 1, right? And yes, that's an impulsive wave, but the problem with it is wave 2 after it can be a nasty wave and actually retrace 100% of wave 1. So it's not like a wave 4. So you need to be careful about putting your stop at certain places. With a wave 4, you can put it under a fib retracement area very easily and feel fairly confident, not all the time, but fairly confident that that will hold during the pullback. But on a wave 2, you can't do that. You have to put it at the bottom, because if you get that 100% retracement and then it moves into a wave 3, you want to make sure you don't get stopped out. So don't use a pyramid anywhere in that wave 1 area, okay? Always at the bottom. And if you get stopped out, well, you want to be stopped out because that means you didn't pick the bottom right? So that's an okay place to put it. And then once you get above here, then chances are now you are in wave 3. All right, so there you have it. So now once you're in wave 3, that will be your most hyperbolic move. And then wave 3 ends. And now we're going into wave 4, right? So wave 4 is where our first real chance or opportunity is to draw in fib retracements. All right, because wave 2 can retrace 100%. I mean, you could draw it in between the bottom and the top of wave 1, but it could blow right past that. All right, wave 4 it usually doesn't blow right past that, so it's really the first appropriate place to draw in a fib retracement. Now, when you draw in a fib retracement, the way I have found it work best is always anchor it at the bottom of wave 2 and at the wave 3. You know, there's 2 anchoring points for a fib retracement. Okay, I'll put 2 APs for anchoring points, wave 2 and wave 3. So if wave 2 happens to not go so deep in here, then you would anchor it in here. And what I found based on my studies with this is statistically, I was able to come up with a much more accurate retracement percentage probabilities than if I just chose the bottom of wave 1. So when drawing them in between 2 and 3, 70% of the time, we ended in between the high probability target zone, 31.8 and 61.2. Okay, so those were your probability areas. Okay, and then 15% of the time they went less or deeper, I should say, but never could go into wave 1, because if it does, that means it's not wave 4, it would be a wave 2. So at that particular point. So at this particular point, that wave 4, 70% should hold. Now, 15% of the time, they're shallow and go into here. So now if you're designing some type of set of rules for you to follow to trade wave 5, okay, or even if you wanted to go short and trade wave 4, your target for wave 4 should be here, okay? And preferably, I'm pretty conservative, I make it at the top. So if I get out my trusty risk to reward calculator and I find I can get in early enough to give me a 2-to-1 risk to reward for a wave 4 trade, I'll take it. If not, I won't. But I will wait for the market to trickle on down to wave 4. And if I see bullish momentum come in and I start connecting the dots for another new trade, then once I get the green light there, then I will look for a wave 5 trade, provided once again the risk to reward is at least 2-to-1. It certainly should be. Now, when it comes to connecting the dots, one of the dots we connect is to make sure we hit the 70% target zone. If we don't, and it's shallow, like in here, then I usually cut my trade size back. And this is where everybody's rules are going to be a little different. And you've got to decide after testing and you're knowing your tolerance to risk and things like that, your emotions, you've got to decide what you're comfortable doing. And for me, basically, if I'm going to be strict and say, okay, I'm only going to take a wave 5 if I get a 70% retracement, because most of the time that's what happens, then I'll wait for that. All right. However, if it starts to come down into this 15% area and bounce, and I'm afraid I'll miss it, well, I might go in with a half a trade size here, because sometimes 15% of the time it can take off and the wave 5 high will be even higher, right? But the stop's got to be maybe not here, maybe down here. So the trade size needs to be lower. Okay, and then if it goes back in and I want to increase the trade size because I only took a half a trade size here that time, then I'll do that. So there's many ways in which you can do it. You can either take a full size trade here based on a stop here, or you can take a half trade size that you would normally take even with the stop based here. Okay, so it's up to you. That way you can add back in a higher trade size if you want, because your risk will be a little less once it gets closer. Okay, you can add that other half in. All right, so that's kind of how you want to do that. It's totally up to you. All right, totally up to you. So that kind of getting a little messy over there. So let's go back here. So there's your wave 2, here's your wave 1, here's your wave 3. So we got 2 anchoring points for the fib retracement. There's your wave 4. And now we're off to the races with what we think could be a wave 5, right? Hopefully ending somewhere up here. So how do we know the target range for wave 5? Let me ask you guys that. How do you figure out wave 5 target range? We figured out wave 4. Now how do we figure out wave 5? Fib extensions, exactly. Good. All right. Now, how many anchoring points does a fib extension take or require? So we had 2 anchoring points for a retracement. And once again, correct, Jim, 3. And so you anchored on 2, 3, and just where the bottom of 4 is. And then that will give you a probability area of where wave 5 is going to be. And usually this is 61.8 up to 100. That's your 70% mark. Can go higher and it can go a little shallow, but that's kind of where it's at. So when I do my risk to reward calculations and things, I always try to use this lower one here to be conservative, but you could use a little bit higher. As long as the risk to reward somewhere in that target zone of 70% yields you 2 to 1, you're good to go. So if you had like 1.8 here and 2 would be here, you could go with that because it's in the target zone, right? All right, so now, how do you know, okay, that wave 4 is over and we're in wave 5? How do you know? How do you know? Anybody? Correct. You got to see what the software is telling you in terms of, are we in the next impulsive move? Okay, so you said right. So owl, okay, so the owl has to go green again. So if this was a move here, the owl may be something like this, peak out here, and then we're here with the 0 line. Just gonna try to draw this as straight as I can, like that. Okay, so this would be a bullish wave 3 owl, negative wave 4 owl, and then we're in wave 5. Okay, so you wait for a couple things. Here it comes connecting the dots. Remember, first thing is clarity. Is the Elliott wave clear? That's a dot. Do we see a clear A, B, C correction in this retracement? If we do, that's a good sign. All right. Did it end in the 70% area? If it did, that's a good sign. So now we got 2 dots connected, right? All right. Did the owl make sense based on the Elliott wave count? Because sometimes you get into an extended correction and you'll see wave 3s occurring inside some of the, A, B, C, D corrective waves. So it's not very clear. It's messy. But is the owl clear? In other words, do you have a big impulsive move where the owl is impulsive as well? That's clarity. So yes, the owl is clear. Did you have a negative owl on wave 4? Yes, that's another dot to connect. All right. Now C wave is going to have small little waves inside, right? Did we break the wave 4 that occurred on C wave coming down? That's a good sign. Otherwise, you don't know if C wave's over, really. Could go back into the target zone. So that's another dot connected. All right. So then you take the trade. Hopefully you'll get a pyramid in here as well. All right. And that's the idea. Wait for that pyramid. And that'll put you in. Because a pyramid is great because after a big move up, all right, off a bottom, then you get that retracement, and that's where the pyramid forms. So you can be patient and wait for that. All right, that's all about connecting the dots. And I'm going to go into great detail in my book on that, the new book. So that's kind of the deal behind that. All about connecting the dots. Any questions on that? All right, next thing. Let's say you're in this trade and you're in wave 5, how do you know when to get out? When do you get out of a wave 5? All right. Well, usually wave 5s do go above wave 3, so you're good there. You've done your fib extensions, so you should be in the target for one thing. So you do also kind of an assessment of connecting the dots when you exit as well. All right. Are you in the target zone? Where is the pyramid trading stop? Now, there's a couple things you can do. If your pyramid is down here, okay, remember, pyramids are designed to keep you in a trend as long as possible. So very rarely are they going to really be so close to activity that you'll get stopped out on volatility sometimes. But that's the idea, is it takes into account the current volatility and kind of makes adjustments for that to account for normal volatility. So it's usually going to be a little further back. So when you get into a target zone here, all right, see how many pyramids in a row have formed. Do you have 4 in a row? All right, if you do, then we're getting close to trend exhaustion. All right, then make sure that stop is right under that most recent pyramid. And if you get another one in here and it's in the target, use it, okay? Once you're in the target, use every pyramid inside the target as well. Now, before a pyramid has had a chance to form, let's say it goes up here and hasn't pulled back a little bit for it to get a fractal formation. If this was your target and you wanted to scale out of a third or a half of your position, you can do that, all right? Or you can trail your stop up under each price bar, which is what I would suggest, and then get out of a third or a half of your position if you have a reversal, but your pyramid's still far away. And then once that pullback comes, all right, if it goes back into the target zone, you'll get your new pyramid there, and you can move your stop up for everything there. But this way, you get out at the target zone with a third or a half in case that's the end, and it just comes down and stops you out. That's what I do. And look at the PTF. Another dot you can look at to connect on the exit. Is the PTF green still? So if you reach target zone, the PTF's green, then you kind of want to stay with it. If you still want to take out a half or a third, you might only want to take out a third or none at all if the PTF is green. Now remember, the PTF is right 75% of the time, so it's not 100% either. But so you may still want to take a third off the table in case of one of those 25% times it's not correct, right? So this is all part of your trading plan, your rules, and how you use the software. And this is why everybody can be using the same software and the same rules and trade differently, because they may have made adjustments to their rules based on their belief system and their structure, okay? For example, green PTF, there may be some traders that don't scale out at all. They'll go with the 75% probability, keep their stop at the pyramid, and just let it run as high as possible. Then when the pyramid turns yellow, then scale out. Some may take a third off as soon as they hit the fib target zone, even though the PTF is a green, because that's what they're comfortable doing. So there are the tool, using the tools, exact same tools, and having a little bit different strategy in how you want to do that. And it's going to be based on your belief system and your direct association to fear and greed. And everybody's different with that. The nice thing about our software tools is they allow you to basically create your own paradigm based on how you use the tools and what they're telling you and what that means to you. Okay, so that's kind of important. So that's what I wanted to cover today. I hope you got a lot out of this, because there's a lot of little nuggets in this, and I think it's good that you kind of absorb that. I did record it, and the recording, of course, will be in our YouTube page in the private unlisted area. So you have to access that through the link in the client support portal, okay? All right, anything else? Any last minute questions before I go? Good session today. Thank you for your feedback as well. My pleasure, my pleasure. Yeah, there's a lot of books, Jim, on different strategies in terms of hedging. So yeah, and everybody will do it a little differently. Everybody will do it a little differently, and that's okay. That's the way it should be. Actually, it's kind of like when you play a sport. You know, what makes somebody really great in a sport is making it their own. And the same thing with trading. You want to make it your own and get comfortable in doing that as well. All right. Alexander, my pleasure. Great to have you here. So glad you're here. All right. And remember, thank you, Nigel. Appreciate that. Remember that risk control is really important. So you just kind of want to always have some type of risk control protecting your profits. And at the same time, you know, the fear factor comes in for all of us. You know, every time we take some money off the table, you know, whether we call that scaling out or whatever, it's because of fear. All right, we're afraid that this will be the certain time that, you know, this, you know, I don't want to hold a position any longer, hold position any longer. That's fear, and that's okay. But just try to control it and make as logical decisions as you can based on what the tools are telling you. So if the tools are saying long, say long, but you're really uncomfortable and want to take a little bit off, you can take a little bit off, just do it in a structured way, okay? And try to stay with the trend as long as you can. And it's kind of like once you do that, it becomes easier and easier and easier. And that's the best way to control your fear. Keep it structured. All right, everybody, thanks so much, and we'll see you back here next week. Have a great weekend. Oh, I guess, wait a minute, I should say, have a good July 4th. I forgot, we got July 4th.
Well, I think it's Wednesday.
Yeah, hold on one second.
We're not ready for the weekend yet.
Yeah, but July 4th is on Tuesday, so everybody have a good July 4th.
Oh, yes.
Okay, that's what I was saying. So, can't believe it's July 4th already. Boy, that's the middle of summer, guys. We're gonna blink and it's gonna be Labor Day again. Oh my gosh. All right, so have a good one, and we'll see you back here next week. Have a great July 4th, safe one too. Bye-bye.